Hello, Baker Investments portfolio student. Hope everybody is having a good weekend. We are quickly approaching the end of the course with only 2 weeks left, so keep on top of things. Good job with the forum discussion. We have one final forum discussion weekly portfolio analysis. We had a good day on the market on Friday, so hopefully we continue with the good news, and we'll see, what information is revealed this week that will impact your portfolio. So with that, you have a task stream assignment or the common assessment in this course, the 8 to 10 page paper on a world event. Some of you asked me questions about that, about different topics. Feel free to check with me. Uh, you know, Two I can think of. Well, obviously the first one is COVID. How has that impacted the markets, the financial institutions, the bond market, all those things it's asked you about in this paper assignment. Other one is like the energy crisis, and you could also have like supply chain issues that are going right now, or worker shortages. So whatever you want to focus on, um, pick that topic, go with it. If you need some guidance, do reach out to me via email, or I'm happy to talk to you via Zoom too, or on the phone. And then just make sure it's that 8 to 10 pages. Again, with APA, you should have a cover page. That's page one. And if you wanted to have 6 written pages, and then you have your final page, which is all your references, make sure everything's in order, basically 6 written pages if you met the requirement. If you go over, I'm not too worried about it, but at least get to the minimum. And I'm looking forward to reading the papers. It'll take me a little bit longer to get back feedback on that, but make sure to submit it to TaskStream. That is so important, and you'll submit it in 2 places, and also to Moodle in our course, and that's where I'll post the grade for it in Moodle, so you can see that. So with this week, you have chapters 11 and 12. Chapter 11 gets into different types of bond strategies. The thing I want you to remember as an investor, bonds play a big role for investment. It's not just all about stocks, and bonds are a major way that corporations raise capital. And there are many bond mutual funds out there. You'll read more about mutual funds in chapter 12, but also within like balance funds, bonds are purchased. And bonds tend to have less of a historical return than stocks, but also provide maybe a little bit more stability in a portfolio. So if one is more risk adverse or getting closer to retirement, or you're trying to meet an objective, they may be more likely to have a higher percentage of bonds, either investment grade bonds or different types of corporate bonds in portfolio. And as we know from finance, that bonds can change in price due to changes in interest rates. So I put the treasury yield curve out there. It's a snapshot. And also, the text goes into the theory. It's once again with, why is the treasury yield curve shaped the way it is? The idea of like expectations theory. Do I buy a 1 year bond or 2 year bond? Well, in theory, those prices, if you buy a 2 year, you could go out and buy 2 1 year bonds. The average of those returns should be equal. And then there's market segmentation that says that there are investors that want to buy short-term maturities or lend short-term, investors that want to lend long-term and buy long-term. So depending on the supply and demand of those markets, that can influence bond prices and interest rates. And finally, just liquidity, which would be expected that the longer you're holding your bonds out to maturity, investors would want a liquidity premium for that and would expect a higher rate of return. So with that, again, just the kind of the idea, they'll do some review with the concept of pricing. Again, it's an inverse relationship. When interest rates go up, the present values of the bond goes down, the price of the bonds. The opposite when interest rates drop, we would see that the price of the bonds go up. So right now, kind of the consensus or idea in the market is that with all this inflation happening, Social Security, I think, is going up like a 5% increase for those that receive Social Security checks, that at some point, especially with all the government spending that we're doing right now, I don't know it's necessarily always the best way that's targeted. I believe in that, but they do a lot of stimulus payments, especially with the child tax credit and other ones. It's when I went out to lunch on Saturday, try to take my wife out, it was just that there were so many worker shortages, so it's I kind of makes me think, about how much is there a need for work, or for you people, the choices they're making. Maybe now they're making the choice not to work, and maybe they regret it later, to come back and say, hey, please, I want a job now. but that's definitely something we're observing in markets. So it's I think it's good in economic theory with the way they've done things with the monies, because it's an easy way to do it and get monies to people so they start spending. But at the same time, if you're giving away too much money, it kind of decreases incentives for people to want to work. And that's where we're having a lot of the shortages right now in the employment sector. So with that, also with this chapter, you're going to read about duration. Again, I like how the textbook put it. In their definition, you think about it's a calculation that's getting you to what we would call the average weight, if you will, of the time from, let me make sure I get it here because I'm point out the page it was on. We have, let's see, here it is. So it's the average timing of the bond's cash payment. So obviously with the way duration can help you as an investor is to understand how, if interest rates change, how will that impact my bond portfolio? And there are professional bond money managers. In the beginning of the textbook, they had mentioned especially about how one individual from the PIMCO fund had did so well over the years, but made a mistake too, and just kind of shows that his advice to get out of treasuries, actually moved opposite directions. So no one is ever perfect or exactly right in this game of investing. It's so hard, either try to read tea leaves or crystal ball about what's going to happen to the future. You may have a really good run, and this has happened with economists that were hedge fund managers that thought they could do no wrong, and they bet in the wrong direction. So um, you're never going to have a perfect model, a perfect understanding of the market. So, but you could definitely implement strategies to try to improve your returns over a longer period of time, and try to make the best choices based on your willingness to take on risks. So, but with that, you'll go through and review the calculation for duration. Just read it slowly. But again, the purpose of it is to help an investor understand, especially if there's a strategy they want to use to say, hey, that I have a certain objective. I'm going to retire in 10 years. I want to get that duration in place that exactly meets my timeline. And then I can kind of offset what they talked about in the textbook about those opportunities. If interest rates do rise, you lose on the price of the bond, but you also have the benefit of reinvesting at higher rates. So it's the offsetting of these forces that duration takes into consideration. So you'll read a lot more about that. Then when you get to the next chapter, mutual funds, you'll look at the understanding of the mutual funds, how net asset value is used, which may be more popular today, exchange traded funds that has both properties like an open and closed fund. And the benefit with exchange traded funds, they said, and the authors talk about, is that it can be traded daily. You don't have to wait until the end of the day when the price closes, and you could literally hold on to an ETF just like a security and not have to worry about capital gains every year like you would on a mutual fund, where they have to give out the forms and the tax forms and say you made this much in a sell or an income received. So there can be some benefits and become, as the authors noted, very popular in right now with the growth. I think they said about a 50% increase every year since they were first started in the early 90s. So other than that, I hope you have a great week. I hope our last week with our portfolio experiment works well. I finally just about broke even. I know that I'll get one more dividend for one of the stocks. So do track those dividends. Check that. But I think it's been a valuable experience for you all too, to kind of see volatility in markets, understanding how analysts make opinions about stocks, the beta associated with your stocks that you've chosen, and also to help give you some insight about future decisions. When most of us do the investing through mutual funds, and there's so many of them out there now. But again, trying to keep pace with that market, most professional money managers have a hard time beating the market. So my advice, I've been giving this since the 90s, is just pick a low cost S&P 500 index fund, and you're going to probably do better than most people out there. So that's what I was told in graduate school. It seems to hold true every year. So with that, do email me if you have any questions. And one last thing with mutual fund, I just want to point that out. I just make sure too that you really understand the cost associated with any mutual fund. Um, they can really eat away at your returns. The idea, again, I was kind of belief of that your idea is to try to improve your net worth over the lifetime. You want to spend your money to enjoy life too, maximize your utility that we have in economics. But if you're trying to reach a certain goal, most of it for us, it's the retirement piece. A number that we have in our head that if I get there, I can feel comfortable that I don't no longer need support from a job or whatever it be. But for many Americans, they're not even close to meeting that goal. They're going to really struggle when it comes to those later years. So, at least to get out of this course is really think through your strategies and more so have a number in mind that this is what I'm going to need, to reach my goals of retirement someday. So, have a great week, and we will talk to you online. Take care.